Qualified Charitable Distributions, known as QCDs. Let's break it down on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today's episode, we're going to be breaking down QCDs, or Qualified Charitable Distributions. So this kind of builds upon our episode there a couple back on RMDs, required minimum distributions. I mentioned there how you can satisfy your required minimum distribution through a QCD. So this episode kind of builds upon that. So what are QCDs? They're tax-free donations directly from your IRA. So directly is key terminology there. You can't take a distribution from your IRA to yourself and then pass it through to the qualified charity. It has to go directly from your IRA to the charity. And I said IRA because you can't do this from a 401k or another qualified retirement account. It has to come from an IRA. So if you wanted to do it from a 401k or your TSP or whatever it might be, you'd have to do a rollover first to your IRA, and then you can do this QCD from your IRA. So the advantageous part of the qualified charitable distribution, other than being charitably inclined and helping a qualified charity, the self-motivation would be QCDs don't count as income like a regular distribution would from your pre-tax IRA, right? So a normal distribution from your IRA, your pre-tax or traditional, you take that distribution, and if you take $50,000 distribution in that year, that $50,000 is going to be recorded as regular income for tax purposes. If you do a QCD of $50,000 from your IRA, it is not counted as income for you. It just goes directly to the qualified charity, and no taxes are incurred from you. Now, a couple rules to be familiar with is you must be age 70 and a half or over when the distributions are made. So I believe it's not in the year you turn 70 and a half. You actually have to be older than 70 and a half. I believe older by at least a day, 70 and a half, when you make this distribution. So there's no sense in towing the line there. Just make sure you're over that age before you consider doing these qualified charitable distributions. The maximum, it just increased slightly. It was $100,000 per year. Now it's, I believe, $105,000 per year. You can do these qualified charitable distributions, and in turn, avoid counting this distribution as income because it goes directly to charity. That $105,000 per year is per person. So a married couple could do $210,000 per year. Granted, it has to come out of each spouse's own IRA, right? Because the IRA is individual. You don't share them. So each spouse could do this out of their IRA for a total of $210,000 for the married couple. But $105,000 each per individual. Keep that in mind. One thing to consider also is it has to go to a qualified charity. It can't go to, Auntie Sue's, whatever it is, cupcake shop down the street if that's not a qualified charity. It has to be a qualified charity as defined by the tax code. So there's kind of a list of rules, and a qualified charity has to become qualified through applying to the IRS for that specific qualification. So I'm sure you can Google it and find out a list of all the qualified charities that are out there. And if you're unsure, just consult your tax advisor and say, hey, I'm going to do this QCD strategy to this charity. Can you confirm with me that this is a qualified charity? Because if it's not a qualified charity, I believe at that point it's just considered a gift, but you would still incur the income on the distribution. It'd be a distribution and then a gift, if I'm not mistaken. So just double check that it's a qualified charity. You'll be familiar with a lot of the big name charities out there. So if that's one you're going to, you're probably in good shape, but just double check that first. The other thing to consider is if you're still working at 70.5, which some people are, contributing to an IRA may result in a reduction of the QCD that you're going to make. So it gets a little murky when you're still contributing to an IRA, but also at the same time trying to make a qualified charitable distribution out of the IRA. It gets a little murky at that point. Definitely speak to your tax advisor. I'm not familiar with all the intricacies at that point. It's probably best if the easiest, simplest way to do it is hopefully you're retired at age 70.5 and you're not still contributing to your IRA. If you're still working, maybe you're still not contributing to an IRA. And that way there's no other implications on your QCD. So that's the broad overview of what a qualified charitable distribution is. So there's a lot of great tax benefits. And also, if you're charitably inclined and maybe RMD time comes up and you're required to make those distributions and you don't need all that money, maybe you can take a tax deduction and satisfy, your itch to charitably give. And I think that's a great thing to consider. So you just got to figure out for yourself, does it make sense for you? And consult your tax advisor when that time does come. All right, if you have any other questions on QCDs, shoot me an email at aloha@hawaiiretirementshow.com, and I'll catch everyone on the next episode. All right. As always, mahalo for tuning in and listening to the Hawaii Retirement Show. If you haven't already, please subscribe to the show on whichever platform you choose to listen on. If you have a retirement planning question that you'd like us to talk about on our show, please email it over to aloha@hawaiiretirementshow.com. And until next time, aloha and happy planning.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.